Welcome back, champions. Another mind-boggling stock news. Property and casualty insurance industry rose 11.5% last year. Increased exposure, streamlined operations, global presence, better pricing, solid underwriting, and a strong capital position likely helped the industry perform well. As per Fitch Ratings, the industry is poised to perform well going ahead, banking on improved personal auto, lower claims, and an increase in investment. The performance of non-life insurers is measured by underwriting profitability. Catastrophes also impact pricing in the space. Improved pricing drives higher premiums, ensuring smooth claims settlement. This, coupled with better investment results and lower claims, should fuel insurers' performance this year. The insurance industry also benefits from a rising rate environment. Accelerated digitalization continues to improve scale and efficiency. While a solid policyholder's surplus helps the industry absorb losses, a sturdy capital level supports inorganic expansion, investment in growth initiatives, and capital payout to shareholders. Here, we focus on two property and casualty insurers: WRB Corporation and Cincinnati Financial Corporation. WRB, with a market capitalization of $18.6 billion, is one of the nation's largest commercial lines property casualty insurance providers. Cincinnati Financial, with a market capitalization of $16.7 billion, markets property and casualty insurance. Let's now see how these property and casualty insurers fare in terms of some of the key metrics. Number 1. Price performance. Cincinnati Financial has gained 1% against WRB's decline of 2.6% in 2023. The industry has risen 11.5%. Number 2. Return on equity. WRB has a return on equity, ROE, of 18.5%, which exceeds Cincinnati Financial's ROE of 7.4% and the industry average of 7.2%. ROE measures how efficiently a company is utilizing its shareholders' funds. Number 3. Return on invested capital. Return on invested capital, ROC, is a profitability or performance ratio that aims to measure the percentage return that a company earns on invested capital. The ratio shows how efficiently a company is using investors' funds to generate income. WRB has an ROIC of 9.3%, which exceeds Cincinnati Financial's ROIC of 2.6% and the industry average of 5.5%. Number 4. Dividend yield. Cincinnati Financial's dividend yield of 2.9% exceeds WRB's dividend yield of 0.7% and the industry average of 0.3%. Number 5. Debt-to-equity ratio. WRB's reading of 40.9 is higher than the industry average of 24, as well as Cincinnati Financial's debt-to-equity ratio of 8.2. Number 6. Growth projection. The Zacks consensus estimate for CINF's 2024 earnings indicates an 8.5% increase from the year-ago estimated figure, while that for WRB implies a year-over-year increase of 20.1%. WRB has a growth score of A, while CINF has a growth score of C. Number 7. Combined ratio. The combined ratio represents the underwriting profitability of an insurer. CINF's combined ratio for the first 9 months of 2023 was 97.5, while the same for WRB was 90.1. Number 8. Net margin. WRB's pro forma net margin for the trailing 12 months was 10.7%, higher than CINF's reading of 8.1%. Number 9. Valuation. CINF shares are trading at a price-to-book value multiple of 1.53, lower than WRB's reading of 2.63. The industry average is 1.46. To conclude, this comparative analysis shows that WRB outpaces CINF in terms of ROE, ROC, growth projection, combined ratio, and net margin. CINF has the edge over WRB with respect to price performance, dividend yield, leverage, and valuation. What do you think? Which one is going to get placed in your portfolio? Let us know in the comments.